Okay, my name is Dean Crocker and I'll be taking you through our latest EIA on the Bidvest group. Bidvest released their first half 21 results. This was for the period of 31 December 2021. The results reflected revenue from continuing operations increasing by 3.5%. Whilst organic revenue was actually 5.1% lower. The increase in revenue was thus driven by the recent acquisition of the PSG group and the consolidation for the full 6 months. Trading profit increased by 3.5% to 4.1 billion rand, resulting in a margin of 9.15%. Net finance costs tracked 3.5% higher, whilst cash generated from operations increased significantly by 82%. This was largely due to, we shall say, a difference in working capital utilization during the period, thus less cash was utilized in working capital operations. Net debt was thus improved from 2.1 times to 1.7 times. The 2.1 times being fairly high relative to the previous periods, and that was due to the increased debt taken on to facilitate the acquisition of the PSG group. Normalised headline earnings was down to 22.5%, whilst an interim dividend of 290 cents per share was declared. Looking at the various divisions and the results released for them, services recorded a nice increase in trading profit by 39%, effectively 38%. And effectively, products and services, mainly your facility management, travel services, allied services, security services. Branded products, however, reported a decline of 18.7%. Including branded products, you'll see later on in the valuation table, is Adcock Ingram, which does not account for the full value but is a large component. Freight trading recorded a decline of 0.1%, which was really negligible. They were thus remain nice and flat. The commercial products, which recorded a nice increase of 44.1%. This is largely driven by your protective clothing, PPE type of consumables, as well as industrial supplies, your cleaning materials, etc. The automotive division grew 5.6%, whilst financial services took a nice knock of 39%. And this is largely just due to the lockdown and lack of international travel. Thus, there wasn't much demand for foreign exchange. Looking at the impact of the results, the share did trade slightly higher than the cap Swix on the same day, outperforming it very marginally, whilst since our neutral recommendation, it has outperformed over the period. However, if we look at it on a one-year basis, Bidvest has actually underperformed JSE Swix by quite a margin. On a valuation perspective, PE basis, it does trade at a slight discount to historical multiples. However, it is at a large premium to its peers. This is similarly reflected in EV/EBITDA, in which it trades at a slight discount to its 5-year average. Based on its relative valuation multiples, the company does seem fairly valued, but relative to its peers is definitely expensive. Looking at the assessment, and this is comprised of 2 slides. The first slide really just looking at the sum of the parts. What can be seen and very noticeable is the services division does remain the largest component of the valuation or the business. And this was really bolstered by the valuation of PHS, which is a hard currency valuation, so this does offer some rand hedge comparability and benefit. It does comprise a large value, being 25 billion of the 41 billion, and therefore is a very big contributor to the group going forward. As can be seen from the various valuation metrics, we did try and utilize a comparable metric or valuation component across the board. Adcock Ingram is one of the easiest listed comparables, and you can see that they contribute 4.5 billion of the 75 billion, so really small, but is quite large in the branded products division. Overall, what we can see is the share is trading, based on our sum of the parts valuation, is trading at a slight premium, and thus places on the lower end of the underweight section or recommendation. Just looking at a few of the assessment rationales. So the free cash flow remained very strong, and this allowed them to pay off quite a large component of their debt, improving their ratios. However, their margins and the EBITDA and trading margins did come under a bit of pressure, so the multiple didn't show the full benefit. Net debt did decrease from the 19.1 to 15.8, attributable to the free cash flow, and also the underutilization of working capital that they have historically used in previous periods. Net debt to rolling EBITDA thus improved from 2.1 times to 1.7 times, whilst the interest cover ratio remained at roughly around that 8.6 times, so above the 8 times value. The group's fortunes are, however, directly tied to the local economy. To a large extent, the certain services did benefit from COVID, and the consumables, particularly relating to PPEs, did benefit significantly in that. We do feel that is a bit short-term in nature, and the benefits will, to an extent, start to dissipate. I mean, there's not high barriers of entries in that component, so it really was a nice once-off gain, and it helped offset a lot of the losses that they recorded in the likes of your financial services division, etc. So based on the sum of parts valuation, we do, however, feel the share is an underweight recommendation, and we as such have adjusted our recommendation to underweight for the counter. If you'd like to place a trade, please speak to either your financial advisor or contact the trading desk directly. Details found below. And finally, just please take note of the disclaimer. Have a good day.